Hi, everyone. This is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. For those of you that are new, I'll give you a little bit of a rundown on how the process works. First of all, before we go any further, if you've watched any of our videos, you know that we have to show you this disclosure/disclaimer. So if you are brand new, please take a screenshot of this, read it in detail in your leisure. I will highlight a couple things that the powers that be want us to make sure you're aware of. Number one, we are not registered to give individual investment advice in the United States. And number two, because we have a lot of international viewers and international subscribers as well, any of the pricing that we're talking about is assumed to be in US dollars unless noted otherwise. So those are the two main things. But while you peruse it just for a minute, let me give you an idea of how this process works with TradeFinder. After this, we'll take a look at the market, go through a few things that may have changed from last week, update the charts where things may be headed from here. And then from there, we'll take a look at any case studies that we may have closed for our subscribers on our website, give you an idea of how that works. There are a couple since we were together last week. And then we'll go through and look at case study considerations that we've identified over the last couple of trade finders. Then we'll look to see if there's some that we can find for tonight. Last week we had two. Usually we just do one, but we did two because we're kind of morphing into that idea of maybe not being so directional going into the beginning of the year and the opportunity for more volatility to come around in January. So we're going to kind of stay with that same vein this evening. And then with whatever time we have left at the end, we'll take questions. Please feel free to ask your questions throughout the broadcast, but understand that I will not be taking them during the broadcast. It just throws me off and it chops things up. So we do the questions at the end, and again, with whatever time we have left. So if your question doesn't get answered, please don't think that it was a bad question or you're being slighted or anything. It's just there's a limited amount of time. We get to as many of them as we can each and every week. So that's it. That's how TradeFinder works. So with that said, let's go ahead and take a look at the market itself. If you watched the latest S&P update that we posted late last night, early this morning, however you want to view it, talked about the fact that, with this whole melt up thing, maybe there's a few icebergs in the way. Now, that doesn't mean the market can't navigate around them, right? It's just meaning that it's not just this clear sailing melt up scenario of moving up to 381, but you can see how close we are. I mean, that's pretty amazing how long we've been talking about this 381 level, and our high is 371. So we're within 10 points on the SPY of hitting that target that we've talked about so very long. If by chance you are brand new, here's where that 381 level comes from. Comes from my favorite directional pattern, which is a zigzag. It's within Elliott Wave. Normally you hear of Elliott Wave's 5-wave patterns. The zigzag is a 3-wave pattern. Technically, it's one of the corrective patterns, but it's directional. And it can be directional to the upside or the downside. We had some downside ones in February and March when the market was moving down so fast. But regardless of the direction of the market, within that direction, quite often there are these zigzags. So you don't have to have all 5 waves following the rules and stuff. It gives you more opportunities for potential trades. So we're kind of in this area here between the 61.8% fib extension level and the 100% fib extension level. So we're just kind of winding around in here. Now we had a pivot point high on the 9th of December. And again, watch the video where there's a graphic on there on pivot points if you haven't seen it already. Then there was another one right after it here on the 11th, back the other way. So yesterday we went down, today we went back up. We've basically gone nowhere for the past 2 days, but awfully close to that 381 level. As I said, we still have 2 weeks before the end of the year. So maybe we just chop. Maybe it's not just this 45-degree angle melt up. Maybe it's a chopping type of a move to get to the upside of that 381 level. But I am so excited about January. If you've been watching these trade finders, if you've been watching our videos and you haven't subscribed yet, now is a great time to become a subscriber. because it's rare. I've been doing this for over 25 years, and it's rare that I really get juiced up or excited about the market. But I actually can't wait till January. I think January is going to be a fantastic month. I think volatility is going to come back. If you ask any option trader with any seasoning, what's the one thing they want? It's volatility. And I think we're getting that in January. We got the runoff election in Georgia. That's going to affect markets one way or the other. If you don't think it will, I disagree with you. I think that is a key as to who controls the Senate. Historically, the markets are interested in that. They don't want one party controlling everything. And once that's decided, again, the volatility could be either direction. Doesn't necessarily mean that we're going to have downward moves. I just think we're going to have movement. And I think January is going to be a really good month for option traders. So again, give yourself a Christmas present and sign up if you haven't already and get your 2021 off to a really good start. If you've been watching these, you've seen our record on the case study considerations. It's all out there. We're here every single week showing you. So really not a whole lot else to say to add to what was in that S&P update. So I don't want to spend much more time just regurgitating information that you may have seen already. 381 is the target. It's been that way for a while. We broke above the 61.8% extension. Yesterday was down. Today's back up. Yesterday we gapped to the upside, and I'm perfectly happy with a bullish mentality to the 381 level for us to have closed that gap yesterday. Just get it over with, so that maybe we can drift higher from here. But until we take out that high of the 9th, that pivot point high, there's still a potential that we come down and test this 61.8% fib extension level again. That will be key if we do come down there as to whether we hold that or not. If we hold that and move back up, that's normal. That's absolutely normal Elliott wave Fibonacci action. But if we break below that, especially with that A high here back in the beginning of September, then that's a whole different scenario. But until that happens, we're still looking at that 381 level. All right, so let's take a look at some case study alerts that we closed, that we sent out to our subscribers. This one we entered last week on Tuesday. You can see it was on the 8th. This was on ARKW. Now this is an ETF. It's an internet-based ETF, but it has it has Tesla in it. It's got some weird things in it if it has to be based with the internet. But the main reason that we sent this out to our subscribers, and here's the chart that we were looking at the onset of the position, is we've got a really good wave 3, and we've got a great looking DMI supporting that wave 3 move. And because we're already above 100%, this is an extended C wave. So remember, when you have an extended C wave, you want to know, are you going to the 161.8% level? In order to determine that, our system is to take a look at our confirming indicators, of which DMI is the primary one, to see, is there strength behind that move to where it can be an extended move? Because remember, hitting the 100% extension, that's all the zigzag is supposed to do. It has done its job when it hits the 100% level. But sometimes the wave 3, a C wave and a zigzag, a wave 5, become extended. They become extended waves and they go to the next fib level. Well, that's what the 161.8% level is. So having such a strong looking DMI gave us an indication that, yeah, that's likely that we're going to go up to that level. Now, again, the reason you can see next gen internet, the reason that we entered it is because there is a Bitcoin trust, the Grayscale Bitcoin trust, that ARKW actually owns. They own part of it. They don't own the whole thing, obviously. So it was kind of a really convoluted, roundabout way of getting our subscribers to dip their toes in the whole Bitcoin phenomenon, which we'll be talking more about in the future. Now, the interesting thing here, you can see it says 1 day. It was technically 2 days, but it's the 24-hour clock. So if we close the position out before the exact 48-hour window happened, then it shows it 1 day. But technically it was 2 days. You can see we exited on the 10th. Now take a look at this exit. This is what's interesting. So when we look at this, you can see, oh, well, we opened higher the next day and then traded lower. And then the day of the exit, we had a pretty decent up day, but we're not back to where we were when we entered the position yet. So the stock's price is technically lower than where it was when we got in, but look at the options pricing. We had a 60% gain on those call options in less than 2 days, and the stock is technically just a tick lower than where it was when we got in. How does that happen? That is a great illustration of the importance of options pricing. I've been asked this question a lot because I guess I arbitrarily say, oh, those options are expensive or whatever when I'm looking at the options chain, and maybe it's just off the cuff comments and I don't realize I'm saying them, but people are like, what do you mean options are expensive? Well, when the premium is juiced, when there's added implied volatility, that's what market makers can control. The rest of it is a mathematical formula that the market makers have no control over. But implied volatility, they can control. They're allowed to do that by securities law because they can talk about fast moving markets. I could spend 15 minutes going through a dissertation on that. I don't want to do that at this point in time. Maybe we will some other time. But it just shows the importance of understanding option pricing and whether options are historically inexpensive or historically expensive at the time you enter a position. If you're going to enter a position when options are expensive, then you want to do a spread. You want to have a buy and a sell to counteract that extra volatility that's in there, or the exact opposite can happen to you that happened to us, where you could have the stock go up and the value of the call options go down. Here, the stock actually, well, between a downward move and an upward move was really a neutral move, but yet the options went up 60% in value. That's a lot. So there was IV that was juiced in. Why? Why would that happen? Is there something coming out of this? Maybe. I mean, we may look back at this at some point in time and say, oh, you dummy, you got out way too early. So far, that hasn't happened. So far, we've just been kind of treading water here, but you can see where the target price is. This was originally what we were looking for, was up around 170, but when you can get 60% in less than 2 days and the stock hasn't even gone your direction yet, you take that. That's a gift from the market, and it's almost like the market would be offended if you didn't take that. So we did. We took it, and we're still watching this and still keeping an eye on it, and we'll see if we start to make a more definitive move to the upside. You can see the next day we had a doji, and you're like, okay, here we go. We getting ready to bounce? Man, not really. The next 2 days, not much has happened. So why were the premiums juiced? I don't know. Maybe we just haven't seen the move yet. Maybe we're going to have an explosive move. We're going to have a big up day on the call options, and they'll suck that volatility back down at that point. Who knows what's going to happen? But it does show that paying attention to option pricing matters, and it really does affect your bottom line as far as, are you entering option positions when they're inexpensive or expensive? Are you using strategies that take advantage of when options are inexpensive or expensive? Or are you putting on positions that maybe you shouldn't be putting on, depending on the pricing of the option? So I wanted to share that one with you because it was so unusual as to what occurred. In addition, we also closed out OZARK here. This was closed out on Wednesday after we got together last week. This was one of the financials. We have another one. So we went ahead and took this gain, which was 61% in 21 days. So this is a little more than the norm, right? Because this is about how things work. Usually 2 to 3 weeks is about how long the position takes, and a 61, 62% gain is a decent gain. This is kind of the norm. This is just like a ho-hum, run-of-the-mill average position. It's not 60% given to you in less than 2 days for nothing happening like the ARKW one was. So here was our entry back on the 17th, and this is the chart pattern. You can see that we had broken above those recent highs from back in June. All the consolidation on that support level. We came down, we tested it. The DMI suggested that that's going to hold. That support level is going to hold, and we're going to march up to that 31 level. Well, we did. We moved right up to that level. And as you can see, there we were, right smack in the middle of where that tap box was before. That's this area here where that 5 is. It's called the time and price projection box. But notice it's moved up because this wave 3 has extended higher. They moved the target up, but we hit our target. So we hit our target price. If you put on a position and you have a plan in mind when you put the position on and the stock hits your target, because it's not that easy, right? For the stock to hit your exact target. I mean, that's what we're trying to do, but we know that that's not 100%. So this is kind of the other side of the coin of, when the market gives you a gift and you don't take it, it's like the market's offended. Same type of thing. If the stock hits your price target and you don't take the trade off, maybe you're getting a little bit greedy at that point in time. You could look at this and say, but the 5 moved. So I'm going to stay in there a little bit longer, and that might work out. But how long is it going to take to get there? Are you going to get the wave 4 correction before we move up to the new higher target? All those things come into the mix. But the bottom line, in my opinion, is we hit our target. That was our original plan. We hit it. Take the trade off. Take the profit, be happy, and move on. And don't look a gift horse in the mouth. So 62% on that one in just 21 days. And then the third one that we've taken off was on FLIR. This one was 37.25%, same time frame in the 3-week period. And you can see here that we had this ascending triangle pattern. So when you get in that 30 to 70% profit range, that's what we're looking for the profits on our volatility portfolio. We can look for bigger gains in the impulse portfolio, the directional trading. But the 30 to 70%, that's kind of what we're looking for on these strangles because we're buying a call and buying a put. Even though we're putting the math in our favor and we're guaranteed for the option that's in the direction of the breakout to make money as fast as mathematically possible. And we're guaranteed for the option that's going the other way to lose money as slowly as mathematically possible. There's still no substitute for the fact that one's making money and one's losing money. We can put the math in our favor best as possible, but you can never change the fact that one's going to be making money, one's going to be losing money. It's going to affect the overall profit in the end. So we put the math in our favor and we accept what comes. And in this case, it was better than 30%, 37.25%. 23 days is actually a little less. On these strangles, we kind of inch a little towards the 30-day mark for our average. But with the breakout that we incurred, you can see that we broke out and we're right up. We closed this gap. We're right up against a resistance area. It made sense at that point in time to go ahead, take the profit. Again, being in that profit range, you don't want to wait, let the stock drop back to the downside and maybe give up some of that gain that you have in the call side of things. So there's 3 profitable trades, all been closed out since the last time we talked here on TradeFinder. So that's hopefully interesting to you. And now we're going to take a look at a couple of the most recent case study considerations on the 1st of December. So this will be 2 weeks ago. We looked at T-Mobile. So let's see what T-Mobile's doing. Not a whole heck of a lot. Still in a wave 3, trying to hold this area here at 130, which is a pretty important support level. Now you can see the DMI has changed a bit from 2 weeks ago. The ADX has rolled over. The positive directional indicator is heading down. The negative directional indicator is heading up. This is not the ideal scenario as far as, hey, we're going to hold here and move. But nonetheless, 130 is an important battleground level here. You can see it was resistance in November. We broke above it, and through December, it's been support. You got to give it a chance to hold that support level and move back to the upside, even with the fact that the DMI is saying, yeah, the upward move is not as strong as it once was. Well, it's been going sideways for a couple weeks. So that's understandable. So we can take that off. But the key here is we want to see this hold the 130. If it breaks below with a confirmation day, then we either need to adjust it or just get out, because probably 110 is the next level in a very short period of time. But we need to let it do its thing. See if it's going to hold this 130 level before. So at this point in time, if you were following along with this one, I wouldn't get out yet, but I would be conscious of, you know, we're on shaky ground here, no doubt. But we need that break of support with the confirmation day. And if we get that, then either adjust it and trade to the downside, or you close the trade out and move on one way or the other. Well, then last week we did two. So we did Nike as a directional trade, because that's been showing up. That had a down day yesterday, up day back today. So let's see, last week was the 8th. So we closed at 139, and we're basically where we were a week ago. So kind of had a couple down days, and we've recovered that. So we're about 20 cents higher than we were last week at this time. And the ADX still looks good here. Hasn't reached 40 yet and still moving to the upside. We'd sure like to see that positive directional indicator get a little more excited, some buying coming in here. We'd want to see that turn around at some point in time. It didn't today, which is disappointing on a pretty decent up day. The stock was up $3 today, and the positive directional indicator yawned. But if we break above this high here from the 9th at 140, I suspect that positive directional indicator turns back to the upside. The positive here is that the negative directional indicator went down as well. So maybe there weren't any buyers, but there weren't any sellers either. So there wasn't really any seller pressure. This kind of, the sellers are gone away. Just wasn't a whole lot of buyers here. Wasn't a whole lot of buyers, one of the sellers, so the stock goes to the upside. That's kind of how things work out. So that still looks good at this point in time. Again, considering what the market's done over the past week, the fact the stock is even a penny higher, I think is a good sign. And then TFC, which we did send this out. We already had done a trade on Nike, but we sent this out to our subscribers as well as a strangle. And I'm going to go back 2 days, because look what happened. So here was our triangle that we're looking at, and this was just way too good to ignore. And remember that we had this kind of an oddity pattern where we had that contracting triangle immediately following an expanding triangle. So we had a really nice, you don't see a whole lot of them. They're there, but you don't see a whole lot of them. Expanding triangle that broke out and then consolidated that breakout in a consolidating triangle or a contracting triangle. And here's the wave 5 target. And Elliott would lean towards the movement to the upside. As I mentioned last week as well, it's been my experience that when there's a triangle, regardless of whether it's in the wave 3, is it a corrective triangle? Is it a triangle within a strong wave, etc.? It's a triangle to me. And so from a trader's approach, which is my approach, a triangle is a triangle, meaning it can break either direction. Maybe I give up a little bit of profit here or there by not staying super pure to Elliott's guidelines. It's just been my experience that, hey, having both sides has generated profitable trades when picking a direction might not have. So I'm not going to change that. And absolute pure Elliotticians can say, well, you're not staying true to the system. I think I'm a pretty good Elliott wave technical trader. I don't think there's anything wrong with doing things that you've observed over a long time trading Elliott wave that maybe put the percentages a touch higher in your favor than just pure Elliott wave does. That's how I view this. You can disagree with me, and that's okay. That's my viewpoint. So boom, yesterday is like, wow, look at that move to the downside, breaking out of that triangle. Here we go. We're off to the races to the downside. And today is like, not so fast. So right back up. So down yesterday, back up today. So look at that all-important 10-day moving average, and you can kind of see we broke it yesterday. Did we get oversold in one day? Yeah, not really. You know, it's a $40-something stock, so it's not the most volatile stock on the planet. You could say that, oh, there's a little separation there, but we could easily gone down again today, but no follow through today. Yesterday, that's a breakout day. That's what you want a breakout day to look like, just like that. And this is where the head fakes come in. And we even had a subscriber say on one of our, it wasn't on this one, but on one of our positions that, hey, the stock's broken. Why don't we take the other leg off? And this is exactly why we don't do that until we have confirmation that that move is definitive in the direction that it's going. And then maybe you can take one leg off. Still a little bit hesitant to do it because you get head fakes. They happen all the time. It's part of what traders do. They try to suck people in and thinking like with that move yesterday, it looked like, all right, here the financials are done. They're toast. They've been good, but now they're done. We're going to the downside, and we turn around and came right back up today. Let's take a look at volume just for the heck of it and see. Well, you can look at that and say, yeah, well, we had average volume yesterday on the downward move and below average today. Well, that always matters. I've mentioned this in the past. This is something that you'll hear me say again. As well, you know, the gaps get filled, 10-day moving average, all that kind of stuff that I talk about over and over again. Elliott wave is a fantastic technical indicator. The confirming set of indicators that we utilize, by the way, if you're new, you can go on our website. We have a trade scan web series there where there is basically a webinar on each of the confirming indicators that we utilize. If you want to see what's our system, how do those indicators work, it's right there at ewotrader.com. You can see that information. But as far as completely lost my train of thought. I have no idea what I was about to say. Oh my, that's what happens when you get old. But as far as, I was going to talk about the fact that we don't take one leg off on these head fakes. Head fakes happen all the time where market makers will try to lull people in to dumping a position, and then that gives them more leverage on the other side. So looking at a bar like this yesterday could have caused people to consider getting out. You can see we did actually trade lower today, but then we closed up and closed back near the highs. And so we're back towards this 10-day moving average. So the second day, confirmation day, follow through day, that's a big rule, just as the 10-day moving average rule is as well. All right, so that's the case study considerations over the past couple of weeks. Let's take a look at our scanners and see if we can come up with something interesting for this week. Now notice the consolidating stocks here. We're up to 108. Do you remember over the past couple of weeks, we were at 73, then 80 something. I don't remember where we, but the last several weeks, the consolidating stocks has gone up each week. So that's telling us that going through this little consolidation here that we are in the market, stocks are starting to consolidate as well. Some of that is normal in the normal this time of the year melt up scenario. So that occurs. It's not that unusual to have more consolidating stocks. But I think that as those are starting to tick up, it's telling us that there are fewer directional stocks and getting more of these that are starting to move into the consolidation patterns and something to pay attention to. Now we do have 6 impulse stocks. That's moved up today as well. Yesterday there was only 1. So just with today's move, we had some move up. So we'll look at those compared with the stocks that are in the wave 3 and see if, well, there's one, LPL Financial. So that's actually a broker dealer. I really wasn't too excited about doing anything directional tonight. I was going to kind of stay towards the non-directional stuff, but when we have one that's in a wave 3 and it's following the confirming indicators, I always want to look to see if there's a zigzag there. So if you wonder, for those of you that are brand new, let me go through this real quick. For you, if you've been here before, just hang on a second. Over here on these searches where it says Elliott Wave Options, this program is called ProfitSource. People ask me all the time, what are you using? Because they like the charts, they like the cleanliness, it's easy to see patterns, etc. If you're interested in this program, go to ProfitSource.com. ProfitSource.com has incorporated my searches, which are the EWO searches here. So when it says EWO, those are my parameters that are pre-programmed in here for you. So it allows our subscribers to follow along with the searches that I'm looking for. And so they can send me questions, which they do all the time, and say, hey, in your search, XYZ showed up, but you didn't send out an alert. Why? But you sent out an alert on ABC. Why on ABC, not on XYZ? It's a learning tool, which is what we're trying to do at Elliott Wave Options. We're not just an alert service. We're trying to educate our subscribers. The idea is to get our subscribers to the point where they don't need us anymore. So that's an interesting business model, isn't it? You're trying to create a scenario where your subscribers don't need you anymore. But that's what we're doing. I've been doing this for 25 years. So, you know, what the hell. But we want our people to be able to trade on their own. That's the thing. I was a financial advisor. I was a registered principal. I didn't like it. I don't like the way clients are treated. I don't like the way it's business first. It's bottom line first before clients. That's why I'm doing this. That's why I'm not doing that anymore. And so want to help. For those of you that want to learn, we want to help you. And I think our education speaks for itself, really. So these searches, the Elliott Wave option searches are mine, and then ProfitSource has added these in from an Elliott Wave standpoint so you can combine the two. So what I did was I took my search for bullish impulse stocks and combined it with those that are in wave 3. Now you can see there was 6 that had mine, and then there's 796 stocks that are in a wave 3. And it sounds like a lot, but there's thousands of optionable stocks, so it's not as many as you think. But instead of looking at 796 charts of stocks that are in a wave 3, how about if we look at the system that I've created of indicators and cross the two and see if there's any that are unique to both? And that's where this LPL financial came from. And it had a nice update today. So we're trading at 101, targets basically 110. You look at the DMI, now the ADX hasn't reached 40 yet, so we have a little room there. We're still technically between the two directional indicators. The best things about this DMI are, number one, the huge separation between the buyers and the sellers, the positive directional indicator and the negative. Let's take a look and see if there's any liquidity in these options. Otherwise, it doesn't make any sense to talk further about it. Not really. That's frustrating. We jumped from January to April as far as the expiration months, and there's just very little liquidity, very little. So for that, you'd be trading against the market makers. There's nobody else there. It's you and the market makers. And that's never the greatest scenario. And the reason that I say that is if there isn't a lot of open interest, so if it's you against the market makers, you know, normally we try to pick the midpoint, right? You have a bid and an ask, and normally you try to get filled at the midpoint. And if there's good open interest, you should get filled at the midpoint. If there's a lot of activity going on, if you're not getting filled consistently at the midpoint, you might want to look for a different broker, but you should get filled somewhere around there. But if there's no liquidity, if there's no open interest, they're not going to, the market makers aren't going to say, oh, okay, we'll fill you at the mid price because we like you. You're going to buy at the ask and you're going to sell at the bid, which is the normal traditional way of doing it. So when you're trading against the market makers, it doesn't mean you can't put the trade on. Just understand that whatever the width of the spread is, you're going to pay that. You're going to buy the ask, sell the bid. So you're going to have to try to recover that spread and the profitability of the position that moves. So this looks good from this standpoint, but it's just, in my opinion, it's untradeable. It's tough enough to trade one that has thin open interest, let alone trade one that basically has no open interest to it. So we're going to have to let that one go for now. All right, so let's go back over here and take a look. Now, I did cheat. I don't normally do this. I don't usually do this because I like to have you listen to the thought process. You know, we're doing this for education, right? That's what this TradeFinder webinar is for. It's an extension of the updates that we do, where we try to give you a brief rundown of what's going on in the markets. And so the TradeFinder gives us an opportunity to talk a little bit more than those 5 to 7 minute videos for education. But there's 108 of them. So that would take a while to go through all of those. So I did cheat and look at a few of these, which I don't normally do, just in an effort to save time so we get to some of your questions. So there's a couple of them that I thought I would highlight here. One of them is Herbalife, HLF. And the reason for that is this stock goes through volatile periods. This is the catch-22 of this stock. As you can see, there's been periods of time where there's volatility. There's other periods of time where there's none. So you go through here, you got 2.5 months where nothing happened. Well, then we broke down. Then we broke right back up. Then we broke down again. Then we had a protracted move to the upside. And this was already starting down before the whole COVID thing happened in February, which exacerbated the move to the downside. But note, it was already on its way down in January, where most stocks were moving to the upside in January. So it was already volatile. So the stock can move when it wants to, is my point. And we've been in a trading range for quite a while, which makes it interesting to me as, well, are we starting to get to the point where maybe we want to move again? It's just one to think about. It's not a fantastic pattern, because if you really wanted to get down to, well, where's the pattern? It would be this shorter term ascending triangle right there. And you can see we've had 3 down days in a row. So we've had a breakout day and a follow through day. So this stock is likely coming down to this area around here, but it's trading at 47 now. If 44 is the target, is that enough to make it worthwhile? Probably not in this scenario. But I just wanted to share that one with you. It's one I've traded in the past, and when you catch the timing right, it can really move. I mean, it just, when it wants to, like you can see this day here, down $4. So that's an 8.5% move in one day. For a $40 stock, that's nice when you have a strangle on, and it does that. But I think that we're probably a couple days too late on this one at this point in time. But a couple other ones to look at, MKC. And you can see here, well, note that, let's just do this first. Narrows your zigzag pattern and into a corrective symmetrical triangle. Really nice looking. And do we have a breakout day today? Well, we don't know, right? That's a breakout day, but are we going to get the confirmation tomorrow? So the only issue with this is, does this open to the downside? Look where the ADX is. Remember, I like it below 13. I'll trade them if the ADX is below 15, but I really like it when it's below 13. What's the difference? The lower the ADX is, the closer you are to a potential breakout move. Because remember, the ADX is measuring the strength of a trend. So when a stock is trendless and it's not moving, that ADX just keeps going down. So the longer the stock consolidates, the lower the ADX goes. Well, the lower the ADX goes, you're nearing the end of that consolidation phase, and the stock's getting ready to break out. That's the value of the ADX when it comes to these triangles and our strangle positions that we use in the volatility portfolio, which that's the one that we're beefing up now as we're getting ready for January. We still have plenty of directional positions on at the moment, but we're very selective in adding any new upside directional positions right now. Just feeling like the prudent thing to do is to be set up to where if January is going to be volatile, we don't care which way. If it explodes to the upside, we're covered. If it explodes to the downside, we're covered. That just, it makes sense, doesn't it? I mean, if that's your viewpoint, that January is going to be more volatile, and it is ours, or mine, however you want to view it. I take responsibility for it. That's my viewpoint. So there's the triangle pattern. One day. Now, the only issue could be a gap down tomorrow. If it gaps down tomorrow, then you have to think, well, maybe miss some of the move and maybe it doesn't make sense. But that's a pretty nice pattern. And if we look at the Elliott wave pattern on top of it, you can see that, you know, we're in a wave 4 now. So we've had 1, 2, 3. That was the zigzag pattern. So the end of the zigzag completed the wave 3. Now we're in a corrective 4. All that makes sense. Now, the Elliott wave pattern would tell you we're going lower. And that's what Elliott would tell you. But this comes back to my trader's approach, is that I hear that. Maybe it does break to the downside. It would be great if it did. It's always far more fun when these break to the downside than the upside because they break down faster. So that part would be great. I just can't ignore the potential upside move. Just seen it happen too many times. So that's the scenario there. Elliott's going to tell you it's probably going down, and it may, but I'm saying let's just, you know, maybe tend back the profit target a little bit and cover both sides. And then FNV was another one. This one's actually been showing up. You can see from the ADX that we got down below 13, and now we're just starting to curl back to the upside, which that's interesting. Is something getting ready to happen here on this one? It's maybe not quite as classic of a triangle as McCormick is. That's about as good as it gets. This one's a little more of a stretch here, but it is a very similar pattern. So we don't really have as definitive of a zigzag pattern to the downside in this wave 3, but we went through some consolidation here with a descending triangle. You can see clearly there the lower highs, and then the lows were all hanging in there about 143 or so. And so we broke down, and we went sideways, and we broke back up. Now we're down, and we're consolidating again. This kind of reminds me of GLD, the way it seems to consolidate, break out, consolidate, and break out. Some stocks just do that. But looking at options here, FNV, Franco, Nevada, I have no idea what they do. Sounds like military call signs, but there's enough liquidity. The spreads aren't that wide. You can go out to April and generate a pretty nice strangle on this stock. And again, Elliott's going to tell you that likelihood is we're going down. I still wanted to put a strangle on it. And you can, you know, you obviously have free reign to do whatever you want to do in your own account. I'm just sharing my experience with you. That's it. Just another piece of information for you to process, and then you make your own decisions in the end. That's how trading works. So I'm going to put down 1215 and say that FNV, just because I like the liquidity better than McCormick. If you're wondering, well, why are you picking that one? You said the pattern wasn't as good. The liquidity is better. But we can do them both if you want. I mean, we can. I have no problem with making a note of both of those for this week as our case studies and see where things go from here. That's our case study considerations for this week. At this point, we've got a few minutes left, so I'll open it up to questions. See if you have some look at oil and Apple. All right, well, those two different things to look at. Oil, last I looked like it wanted to go higher. Here's USO, and it still looks like it wants to go higher. So we're in a wave 3. Not too great to look at this for prices at the pump, if you will, but I think $50 a barrel is probably where we're going in oil. That DMI looks really good. The ADX is moving. I don't see anything that's stopping this from moving to the upside. It's really a good looking chart. Not a whole lot of volatility in this symbol USO. So it's a pretty good one really to be a bullish position if you're wanting to put something bullish on now. Again, I think it's time to be a bit selective. Apple, you probably saw that Apple had a move to the upside today. They announced that the news of today was for the reason for the gap up, and you can see we had a triangle here. We've had a triangle in Apple. It was there. And then we broke up, came back down, tested it, and then gapped up today. And the news of the day was that they're ramping up iPhone production for the first quarter next year. So their expectation is demand is going to be higher for the new iPhone at the beginning of the year, or at least in the first quarter of the year, than it has been recently. So they're ramping up production. That's obviously viewed as, oh, okay, well, they must be seeing some signs that demand is picking back up. Now, whether or not it's just something that they said on top of the vaccine being rolled out, or if they see something in their numbers, you would like to think that, it would be more than just the vaccine news, that they're actually seeing increased demand, and that's why they're ramping things up. But if you're wondering what caused that move today, that's what it was. So 5% move in Apple today was pretty good. But from this triangle breakout pattern, there's likely more to run to the upside here. And if we look at the DMI, the ADX hasn't even gotten to 20 yet. You're starting to see some separation between the two directional indicators. If that plays out, and if Apple continues to make this run, it's going to be difficult for the market to move to the downside and struggle if one of the market leaders, Apple, is doing well. But it has to get to, the ADX has to break above 20. We've talked about this numerous times in the past. You can look at that and say, well, yeah, the ADX is on its way up. It's going to break above 20. The two directional indicators are separated. Everything's going to be great. It's going higher. You have to wait. You have to wait for that ADX to actually break above 20. Don't jump the gun. Don't make assumptions. It has to actually happen, because I've seen this scenario too many times where it's like, okay, the next day or two it's breaking above there, and then it doesn't. So it has to actually give you the signal. Puncash, PLTR. And you can see really nice, well-formed triangle formation there. So we don't have a whole lot of data on this stock. All right, so it opened at 10. So it opened at a price where the institutions could get in if they wanted to. Well, they finally decided to show up in November. They took October off and they came in November. You had a big move to the upside, one of those vertical moves that I don't like when it goes straight up. And then we've consolidated. Well, that's the best case scenario. When you have a big vertical move up, the best case scenario is that you go into a consolidating triangle. But I really do like when you have a vertical move that is followed by a consolidating symmetrical triangle. It's my favorite breakout pattern that exists. It's my favorite pattern. This is going to break out. I can't tell you which way. I have no idea which way, but I can tell you this stock's going to break out. It's just flat out going to move. Now, here's the reason it doesn't show up on the search, because look where the ADX is. Just because I like stocks with a low ADX doesn't mean that there aren't stocks that break out with higher ADX. The reason that I like the ADX, again, is the fact that usually when there's a really low ADX, the breakout is on the horizon. It's coming sooner rather than later. When the ADX is higher, you're not getting that signal. Stock can still break out and run, but sometimes it just consolidates larger, makes a larger triangle, and the ADX goes down more, and you feel the effects of time decay before it moves. So because of that, I tend to shy away a little bit more. But this is a volatile stock. It can move. Let's see what the strikes look like. It's got March options. Spreads are a little wide considering the liquidity that it has. A little surprising, but they're not horrendously wide. So it's doable, especially with the fact that the stock will probably make a sizable run when it breaks out. And that's going to be helpful with, they're not enormously wide, but a little bit wide for a $25 stock. Microsoft. Did we make this one an official one? I didn't write it down. Was this an official? I know we looked at it. We looked at it, but I didn't know. Oh, was that? I didn't write it down as an official case study consideration. So if it was, then I just didn't write it down. It's still forming a triangle. And there, look at that ADX now. Wow, you just don't see it get that low very often. That's about as low as the ADX gets. It's below 7, moving to 6.5. Holy cow. So it's a $210 stock. I can't imagine that we looked at this as far as a case study consideration because of the stock price. I don't remember actually looking at the options, but doesn't mean we didn't. I just don't remember it. Yeah, you got to go way down to even a little bit below a 15 delta to put a strangle on this. That's getting pretty low. I don't really like to go much below 1920. So to go 15 or 14, 13, probably where you got to go. I just don't trust Microsoft to break that much. I know it's far more volatile than it used to be. So I don't see how we could have made that an official case study consideration, but we looked at the pattern. I know that. Tesla. I promised the internet that we would look at Tesla tonight. So let's look at Tesla. And here you go again. Got a little triangle here. Not very big, but it is. Lower highs and higher lows. There was the big one. We said this was going to move, and it moved. I was confident that one was going to move, and it most certainly did. It formed a larger triangle. If you weren't here in the beginning, we had this triangle here where that looked good, and then it formed a larger one, as you can see. But as I've noted, when you form a larger triangle like this and it makes you wait, usually the patience is rewarded because the breakout is significant. And in this case, the breakout in Tesla was significant, more than expected. Kind of tried to consolidate in there and it took off again. But now it's consolidating, so Tesla's getting ready to break again. It's not nearly as large of a triangle, but let's see what 660 down to 560. Doesn't seem like 100 points, but it is. So 80 to 100 points is coming on Tesla. I don't know which way, but it's coming. Probably pretty soon. Maybe this week it moves. So as far as commenting on its inclusion into the SPY, it's the 21st of December is when it goes in, but most funds have already bought it now. And so the way that works, if you're not familiar, when a stock is put into the S&P 500, anything that the investment objective says that it mirrors the S&P 500, well, then they have to go buy that stock. So when you're included in an index like that, it usually causes the stock to run up. It's also been my experience that that ends the momentum phase of it too. So I don't think we're going to see Tesla moving forward being included in the S&P 500 have quite the volatility that it's had since its inception. Really, it usually kind of squelches that fire. So whatever stock is getting kicked out, all the investment firms have to sell that stock, and then they have to buy Tesla. But at this point in time, with only 6 days away, most of the firms have already bought it. There might be a few that are saying, oh, well, you know, I hope that it comes back down a bit and maybe I can get it at a little bit of a lower price than where we are now. I think that was some of the stuff that was going on here, where we consolidated this vertical move. Was like, oh, are we going to come back down? And they didn't. So I just don't think there's many firms that are left to have to buy it. Maybe a few, but not that many. The majority of them are already going to be done. Look at a couple of yours, Brian. APS. AAPS. Is that the right symbol? Is that on our exchange? Is that a Robinhood stock? I don't seem to have that one. Surface Oncology. So it's at the wave 4 correction, moving back to the upside. Pretty good intraday volatility. That's pretty amazing, really, for a $10 stock. But here's your key. I mean, if you're looking to see if this is going to go higher, it's got to get above here and hold it. It tried yesterday, and it couldn't hold it today, back below it. But it has to trade above. I forget how long. I don't remember. I should remember, but I don't. How long it has to trade above $10 a share before the growth investment objective, mutual funds, investment companies, etc., can buy it. Above 5, the aggressive ones can. Above 10, growth and income funds can buy it. But it couldn't stay above there. But if it does, then it could have another big run from that point in time forward. If it can hold, if it can get above 10 and hold long enough to where the growth-minded investment funds that want to get into it can, then you can have something really take off there. We'll look at one more, SITM. Well, this is definitely not a Robinhood stock, up around 100. So the wave 5 is 83% extension. The DMI looks good. So it looks like it wants to go to 100% extension. There's 127. Seems like that's where it wants to go. So that looks pretty good to go higher. Kurt, Johnson & Johnson. Let's take a look at that. There's a big old triangle. The ADX isn't low enough. That's why it's not on the search. Look at that. I don't see that very often. A zigzag within a triangle. That's interesting. So that's a really interesting pattern. If it breaks out of here, then you know exactly. I mean, we know where it's going to go because of the width of the triangle, but it's probably going there really fast. If it can break to the upside out of there, and if it breaks down, then it should correct back down to here. It's interesting to have a qualified zigzag within. You got two corrective patterns at work here. Qualified zigzag within an ascending triangle. That's that's unique. So appreciate you showing that. So this, again, Elliott says probably going higher, but my discipline says trade in either direction. Paul, thanks for your question. I'll have somebody reach out to you, and we'll contact you and answer your questions regarding the exchange rate, ProfitSource, etc. So thanks for the comments. We'll get in touch with you. Yeah, we're with all our international people, we're really familiar with the ins and outs of the exchange rate. So can help you. Baron, HON. Look at Honeywell. Holy cow. That may be the biggest move I've ever seen out of Honeywell. This is what I'm used to Honeywell right here. In fact, when I see it on searches, I don't even look at it anymore because that's what I'm used to. Nothing. It just doesn't move. But it's off and running now. I don't know who's buying it, but it gapped up and it's taking off now. So I don't know if there was a news event behind this. Like I said, it's off my radar screen because it just in the past hasn't moved enough to even warrant consideration. And remember, I don't do the at the money butterflies on flat patterns or sideways patterns, but we have a doji today, so that could interrupt this move tomorrow. Looking at that ADX, the ADX is heading towards 50. Strongest part of the move is over. I reiterate this every time I talk about the DMI and show a chart like this. It doesn't mean the move is over. It means the strongest part of the move is over. But usually when this occurs, if it goes higher than this, it's a pretty slow drift and more of a sideways type move. Doesn't necessarily mean it's going to correct. A little nervous about that gap there if I was long. So if you're long and you want to stay long, I would just tighten the stops up with where that ADX is. It's flashing warnings that, hey, that's the biggest part of the run. So be careful from that point on. Target. Target, as they like to call it. Well, it hit its wave 5 target and it's backed off a bit. And it also looks like a completed zigzag. Yeah. Hard to say what target's going to do. It hit its 100% extension in that zigzag pattern, which was a really nicely set up zigzag, 60%, 61%, right at the 61% fib corrective level, all mono waves. You don't see that very often. So we had boom, A, B, C, all mono waves, right to the 100% extension. Those are clean. Those are lots of fun to trade when you see that. So it's hit its wave 5 target, it's hit its wave C target, and my guess, which is just a guess because who knows at this point, it's already done what it's supposed to do. We wait for it to tell us what the next move is, but my suspicion is we're going to come test that 61% extension in the wave 3 high at 170. From there, they could take back off to the upside again if it wanted to. Yeah, I mean, it could form that mono C could turn into a complex C, which would actually make a lot of sense because it is pretty rare to have an A, B, and C that are all mono waves without a correction in there somewhere. Again, the market doesn't always do what makes sense, but that would really make sense that we come back down here a little bit and then head back to the upside. So just maybe a little lower test, maybe not. Maybe that's it because it's 35% now. That could be it. It just, to get that close to the wave 3 high and the previous fib extension level, just seems like it going to get that close. It would want to go ahead and test that. CRM. We just had that acquisition. Usually when you're the acquiring company, then you know, you take a hit. The company getting acquired moves up. The acquiring company takes a hit. Why is that? It's rare when the company doing the buying moves to the upside. Sometimes that happens because they feel like, well, it'll be accretive to earnings immediately. Usually when there's an acquisition, then there's costs that are incurred, right? You have to streamline the businesses, create the synergies and stuff, and there's costs involved there. So usually the company that's doing the buying takes a hit because, first of all, they've laid out the cash to buy the company or the stock. I think in this case it was a stock deal, but you know, it's going to dilute the shares if nothing else. Anyway, the acquiring company usually goes down. The company getting acquired usually goes up. So here we're at 220, and that is support, which was the question that is being asked. That's the support level, but we finished a wave 5 here. We've come down, we closed that gap, but there's another one here. But according to pure Elliott wave rules, we should be coming back down to test this previous 4. Maybe it moves into January before that happens. But yeah, that would be tough to, at this point in time, even with the best case scenario is a bounce up to close that gap. My opinion of a bullish scenario is to jump up and close that gap. But from a pure Elliott wave standpoint, they spent the goodwill here with the gap up on the acquisition. So we're probably coming back lower. NHI and AMD, and then we'll call it a night. So NHI is National Health Investors. Certainly not one that we look at a lot, but that's a breakout looking chart. If you get that positive directional indicator back in the swing of things, it's pretty easy to see what's going on here. You need to break above where we are and hold it. So 2 closes above 70, and who knows where you're going? Probably back to 90, to those recent highs before the COVID stuff happened. And you know, it's a sector that's doing okay right now. Maybe it goes all the way to 100. You're going to get to 90. It'd be shocking that you don't make it to 100. It was probably on its way there before the COVID thing happened. You can see it was moving up. It was above 90. We're probably heading to 100, and then the COVID stuff happens and it just derailed everything. But we may be re-engaging that there. You got to get above 70 though. You need a break above 70 with a follow-through day. If that occurs, it's probably going to 90. So that's really interesting looking. So AMD, I know a lot of you are asking questions, and hopefully you'll be back and ask them again. Well, I'll take a couple more because I was going to let you know that with the holidays coming up, we are going to take a couple weeks off of TradeFinder. So after this one, we'll see you back. I believe it's on January 5th. Yeah, January 5th will be the next TradeFinder. So I'll take a couple more since it's going to be a couple weeks before we chat again. Remember, you want to subscribe, now's a good time to do it. Get ready for that January volatility. So breaking above 95 on AMD, I mean, you know where we're going. It's 2 good days in a row. We had a doji, back-to-back up days. We're heading to 105. After that, I don't know what happens. The DMI looks good. I would be stunned if AMD doesn't hit 105. Really, really surprised. Yeah, Alex, I'll do gold in the middles on Thursday. Thanks for your consideration there. Let's do DTE. Okay, energy, you know, let's look at the XLE. I really wanted to do something in natural gas, but it's just overbought. So it looks like we've cooled off a little bit on energy, although that oil chart still looks good. But maybe that positive directional indicator comes back up. The ADX didn't quite make it to 40. There's still a little bit of room there. It was looking good. It just looks like the buyers have taken a little bit of a pause here. The thing about this, though, is with this, see the sellers are in control here now. The expectation, let's look at that zigzag. Almost to the 161.8% level. So it did its thing. Now, the fact that the wave 5 didn't go above 100% means that you're probably coming, I mean, this might be hard to believe, but you're probably coming back down here to this 4. Tough to go long that one with this chart. Certainly would have to see a considerably different DMI to look long on this. Looks more like a short than a long. Oh, a PPS. All right, let's try that. There we go. Yeah, that's a little different. All right, so we're at 108. So looks like we're going to, it looks like it wants to go to an extended wave 5. Okay, we're right at 100% on that zigzag too. So I need to see that DMI confirm this. It's building, it's looking good, but remember the ADX is not between the 2 directional indicators yet. It's not above 20 yet. We're at some resistance right here. It looks like it wants to go higher. I just need the confirmation from the DMI before I could make that leap. But it looks like it's setting up well at this point in time. We'll just have to see how that all pans out. Qualcomm, holy cow, is that a blast from the past? Used to trade the heck out of this. Tons of money on it forever ago. It was the greatest stock ever at one time. It seemed to go up every single day. And it's kind of got that look to it again, doesn't it? I haven't looked at this lately, but it's, yeah, the ADX is saying, yeah, it's been a fun ride, but we need a rest. I would be surprised if it broke back below 140 with the strength of that move, but then we have this gap, and they're like that, and they're like this gap here either. It's a fun looking chart, but it would need to reset up again. So maybe if we build some consolidation here on 140, it can make another run through the end of the year. I couldn't, if it was me, I couldn't do it right at this moment though. VZN. Is Verizon just V? That's Visa, isn't it? What's Verizon symbol? VZ? Is that Verizon? VZ? AstraZeneca? No idea. We had a triangle and it broke to the downside. Oops, wrong button. But it's at support now. Now, if it follows triangle rules, which they usually do, we're right at support here at 50. It should retrace the breakout. So it should head back up to 54 if it follows the triangle rules. It will do that at some point in time. AZN will move back to 54, but it's one of those things like you don't know when. Doesn't necessarily mean it immediately retraces it. You've seen enough examples tonight alone that quite often it does retrace it fairly quickly, but not always. And so with that big gap down, I don't know if it's going to need to consolidate that for a while. Actually, it looks like a really good time spread at this point in time, but eventually it'll get back to 54. But if it breaks 50, look out. So that's your stop loss. If you're wanting to trade it to the long side, don't give it much room below 50 before you either exit or adjust it to the downside, because it could go anywhere. But from the triangle rules, it should move back up there. RVLV? Oh, Verizon. Yeah, let me do that, and then I'll do RVLV because I have no idea what that is. So Verizon hasn't labeled that wave 4 yet, but that could be the end of the wave 4, holding there at 60 for a run up to 62. You know, the DMI it's not turning up at all yet, but it held today. If it can turn and hold that level, it could easily run to that wave 5 target, but there's your support is at 60. If it breaks that, then there's the gap to get filled. So it's going to fill that. And if that happens, it probably retraces the entire wave 3 and comes down here and starts over. So it needs to hold this level right here. RVLV, right? Is that what it was? Pretty nice day today, that's for sure. Wave 3, 30 looks easily in the car. Oh, that's a good looking chart. That's a great one to finish on. Holy cow. Is there options on this? There are, and it's liquid. Wow. Super liquid. Very expensive options though, but super liquid. It's tradable though. I mean, you can get it down to where you can get a decent delta. Huge liquidity. Wow. That looks really good. So that looks. I mean, at the rate it moved today, 15% move up today, it could get there tomorrow. But it looks like 31 is definitely in the cards. This is pretty classic stuff. This is a really good one to finish on. First, it's a really nice looking chart. So it's a wave 3. You've got zigzag stuff all over the place through here. This is good. Thanks for showing us this one, because this is as good Elliott wave as you can get. Zigzags, triangles, got everything in that wave 3. Love that wave 3. And it came down and tested the recent high, breaking above the wave 5. It held it with a doji blasted off to the upside today. It's got really good confirmation from the DMI. Again, there's no guarantees in the world of trading. There's none whatsoever, but that's as good a chart as you could ask for a stock to continue to the upside. Let's look at the 10-day moving average. I mean, it's not that bad. It could rest tomorrow, or it could hit the wave 5 target tomorrow. But that's a really good looking chart. I like that one a lot. Thanks for sharing that. All right, everybody. Thanks for your attention. Thanks for viewing. Again, we won't see each other again for a couple of weeks into January. I'll reiterate it one more time. I do think January is going to be an outstanding month to trade. If you've had any consideration of becoming a subscriber, now's the time. Get your 2021 off to a great start. Give yourself in your trading account a Christmas present. Thanks so much for watching. I will be doing the S&P updates. So me and the Hat will be back with the updates all through the holidays on the S&P, but we'll see you back here again on January 5th for our next TradeFinder. And boy, I imagine we're gonna have a lot to talk about then. So again, happy holidays to everybody. See you January 5th. And Happy New Year, because we'll miss that too. Take care, everybody.